Welcome to your Monday Market Outlook. My name is Matthew Buckley. I'm the Chief Investment Strategist here at Wealth Creation Investing, and we have a lot to talk about. I hope everybody had a great Labor Day, spending time with your loved ones or significant others, or just kicking back on the couch. So I hope everybody had a great summer. Now it's time to put our thinking caps, our trading caps on, because September and October are going to be nuts. What's going on? Obviously, last week, Bernanke more or less punted. The market was kind of stupid for thinking anything was going to happen. The guy was not going to announce any huge policy changes. That's why they have an FOMC meeting in 2 weeks here, September 12th and 13th. And all eyes, including his, are going to be on Friday's August jobs number. So Bernanke essentially last week, it was almost like a court session. He really defended his policies and quantitative easing since 2008. We've created over 2 million jobs or whatever. I really wish I was in the audience. You've created 2 million jobs as a result of of your quantitative easing. Can you tell me where, what industries? I mean, seriously. So he's almost starting to sound like the president, which is sad. And folks, when you take a look at the market, and here's something that's really sad, what Bernanke said. And, he's a Princeton guy, instructor. So when he talks, you kind of get lost a little bit. But when you take a look at the past 5 years, let's take a look at our quote rallies in the past 5 years. Right there, QE1. Right there, QE2. Right here, Operation whatever the heck they called it. Right here, or no, that was Operation Twist is what they call it, right? Twist and shout. And then Operation didn't give it a name, but we're going to continue asset purchases into the future. And then stand by for Operation U.S. government's going to fail. Folks, the Fed chairman, the man who's responsible for stability in our economy and all that type of stuff, wants you to suck on Fed gas. Laughing gas. He essentially, in his Princeton-like words, talked about the wealth effect. Low interest rates and the bond, our unconventional programs have resulted in equity markets rising. Seriously? That's like the German private who was filling up the Hindenburg. Man, I hope this works, because it's filled up with nothing but explosive air. Okay? So your government is lying to you. They're essentially trying to hide how bad it is out there with quantitative easing. Can you get a loan? Unless you're listening to my voice, you have credit that's over 800%, your name's Noah or Abraham or something, and you want to give your firstborn child, you're not going to get a loan, period. As a small business owner, it's almost impossible for me to get a loan. It's incredible. It's absolutely incredible. The same banks that were stupid listening to the government, like Clinton and Rangel and Maxine Waters, everybody deserves a house, and banks better ease their lending standards to make sure everybody can own a house. News for you, idiots. Not everybody should own a house. Only people who can afford it. But guess what? Now people who can afford it can't get a loan because the banks have gone into full stupidity mode. So, Mr. Bernanke, the low liquidity or the low interest rates helps no one but Wall Street. And the wealth effect that you're talking about equities going up, I ain't seeing it. My wife had my son over in Tampa this weekend at a hockey tournament, so I had my 2 other little munchkins. And went to Denny's, went to Costco, kind of, I did a normal weekend. We went to the beach a little bit. But trust me, folks, nobody feels richer unless you're already rich, right? And I don't begrudge any of those people. They earned it. They deserve it. But who's running around out there saying, hey, my stock portfolio's up. I'm doing great. Nobody. So the Fed is just, it's absolutely in its own country. And what's going to happen this week? Well, let's talk about this week. First of all, We had some auto numbers that came out. Hold on, let me go to the next week here since we're in September. Auto numbers. We had some auto numbers, and then we also had, more importantly, ISM. This number right here was bad. If you don't, Institute for Supply Management, manufacturing PMI, any reading below a 50, and it was forecast to come in at 50, is recessionary. So for the third month in a row, we've seen PMI under 50. Is that good news? Construction spending. It was 0.4%, forecast to be 0.4%, down 0.9%. Manufacturing prices, increasing. By the way, that's not good news. And vehicle sales have been coming out throughout the day with Ford and GM. They've been up, but not as up as expected. And let me tell you something, folks. People worried about jobs and living paycheck to paycheck ain't running out to buy a new Escalade. Trust me. I drive every day into my office in Fort Lauderdale. I drive through Pompano Beach, which is like, all it is, I think, is car dealerships. I think people live in the cars. There is no traffic. I see nobody in those dealerships. So not a good week, folks, and it's not going to be a good week going forward, and I'll tell you why. We have a lot going on. The ECB is going to meet. I believe it is on Thursday. Merkel's going to meet with the Spanish Prime Minister, but the biggest thing for us is going to be unemployment numbers on Friday. Look at this, 8.3%. Economists are forecasting 8.3%. Three things can only happen. And let's take a look at this because this is absolutely critical, ladies and gentlemen. If unemployment comes in worse than expected, meaning we have an uptick in unemployment, 8.4%, what do you think the market's going to do? Well, I'll tell you what, in our crazy market, in our father and mother's market, the market would have gone down. It's most likely going to go up. Why? Because next week, the Fed meets. And Bernanke punted last week. He basically just sat on the witness chair defending everything he's been doing. But he also said, I'm standing by in my alert helicopter full of cash to dump whatever liquidity we need into the market. So unemployment goes up, market probably rallies because that means more quantitative easing. What if it stays flat? I think the market goes up because Ben's going to still want to stimulate it. Because you said last week, unemployment remains at unacceptable levels. Folks, we need, check this stat out, write this one down. We need about 6 to 8 years of 250,000 jobs a month created, minimum, to get back to pre-recession employment levels. Did that sink in? Did that hit your "that ain't going to happen" filter? I hope it did, because it's not going to happen. But also on Sunday, and you're like, all right, Matt, why are you talking about Sunday? Guess what? China is coming out with some very important numbers over the weekend. And folks, our banker is really starting to catch a cold. They're coming out with some price indexes. They're coming out with some information that could move, that will move our market. I'm telling you. So when you wake up Monday and you're like, why is the market doing what it's doing? It's probably because of what came out of China. China is reporting on consumer prices, industrial production, and their trade balance. And if that's bad, we're in trouble. Okay? Because our banker, they're done past sneezing. They've caught a cold, and since they've caught a cold, we're about to drop dead. Okay? Could you imagine the biggest buyer of U.S. debt are the Chinese? What if they woke up one day and said, margin call, gentlemen, just like at the end of Trading Places? Where are they going to get it? Well, you're about to get a nice email from the IRS that says, you, your wife, and your children owe us each $38,000. Or the Treasury, Uncle Ben, whoever it is, keeps the lights on 24/7 in Washington to print money. And is that good for us? No, folks. So we're getting ready to enter September and October. Seasonally, the worst months in the market. But we're actually having a blast. at Wealth Creation with Options. We are our portfolio's up over 45% in 2 months, and that's about $11,000 on about. It's supposed to be about $50,000 in capital, but I'm not using that entire $50,000. So based on what I am using, we're up about 45%, folks. So here's what I want you to do. Come join me Thursday afternoon after the market closes, because I'm going to talk about the Friday jobs numbers and what could potentially happen and how you can potentially hedge or potentially profit based on what the jobs number is. Okay? So I need you to go to wealthcreationinvesting.com/after-the-market. And you can join me Thursday as we talk through all this stuff. And I'll show you a couple potential trades. I'll show you what I've been trading in some of my model portfolios that have just been doing extremely well. A couple of my model portfolios since I've been trading. Let's take a look at from March 1st when I took over one of these model portfolios that I managed. From March 1st through today, and this is on about an average of $45,000 to $55,000 in haircut in a paper trading account, is up over 100%, $58,000. So sometimes this was on $45,000. That's some superior execution, folks. So again, join me Thursday after the market closes. We're going to talk through all this stuff because I can't do this in a 5-10 minute video. Okay, got a lot going on. I just spent 2 hours in a live trade brief with our Top Gun traders, putting on trades, taking off trades, and managing that successful model portfolio. So you got to join me Thursday after the market closes, just so you can see my take on what the jobs report means, what the data throughout the week meant, and what's going to happen at the Fed meeting. Okay. So I'm Matthew Buckley, the Chief Investment Strategist. There's your Friday. I wish it was. There's your Tuesday market outlook. So I got to get back to trading, and I'll see you Thursday after the market closes.